Chris, what is Western Alternative Strategies?
Distilled down, it is a multi-series limited partnership that's designed to give high net worth individuals, our client base, other people's clients, et cetera, access to alternative and private investments. And I would define that as anything that sits inside a limited partnership vehicle. So as opposed to a stock or bond that you could trade either directly or via a mutual fund, investing into a limited partnership requires partnership documents and that kind of stuff. So this was really set up not as a product, we talk about this some, but as a solution to access the whole world of private investments for people, which is otherwise difficult to do.
Why did we build this solution?
So the way I look at it very simply is if you're not, if you have a portfolio and you have no exposure to private or alternative assets, you're intentionally ignoring a huge part of the market. And so I'll give you an example that's an easy one. Technology companies. What you used to see, and this goes way back to the 70s and 80s when companies like Apple or Microsoft went public, and really lasted through the mid 2000s. Amazon, even Google, all the way through, is companies would go public the instant they had enough scale to do so, because being a public company was the way that you could get growth funding for your business. And so small cap technology stocks in the 90s and 2000s, that was a thing. There were small cap tech stocks that went public. The valuation might be a couple $100 million. And the value that is created there, Amazon being a perfect example, accrues to the public shareholders. Today, companies do not go public at a small size like that. They will stay private typically till 10 billion. I think Uber was 40 billion when they went public. So if you're not investing in venture capital, which has overtaken the small cap tech space, then you're intentionally avoiding small cap technology companies.
Who should and who can access, and for the record, we refer to this as WAS, is that correct?
Right, Western Alternative Strategies LP, but WAS, WAS for short.
Who should and who can access this solution we call WAS?
Well, so it's set up in a way that qualified purchasers are the primary ones that can access it. There's some arcane rules around this that the SEC sets, and people hear the term accredited investors or qualified clients or qualified purchasers, but effectively the qualified purchaser or the QP is someone that has $5 million of investable assets.
How can a person access this solution?
So we custody all of our client assets through the major custodians, which are Fidelity and Schwab, and we use another one as well. But Fidelity and Schwab represent over 90% of the market today. The WAS platform is approved on Fidelity and Schwab. So our clients, or me personally, or whoever we're talking about, can directly through that custodial relationship then be an investor in Western Alternative Strategies, and looking on their app from the custodian, see the balances, see the positions, etc. The goal of this, the whole thing, is to provide access to an asset class that would otherwise be complicated and difficult, and to simplify it where the client, the ultimate end client, doesn't actually have to deal with all those complications.
Generally, what does the client look like other than needing to be a QP? What do they look like? What's the profile of a person accessing WAS?
It's a mix. There are high net worth and ultra high net worth individuals that are investing on their own behalf. There's individuals that are coming through and have relationships with a registered investment advisor, and that advisor is bringing a number of their clients into the vehicle. And there are single family offices, multifamily offices, et cetera. The client is always the ultimate end investor, though.
Okay. If I own an RIA, why should I at least consider WAS as a solution for my clients?
Well, I think everybody that owns an RIA today is being dripped on constantly by the large asset management firms. There was an article in Bloomberg today, it's November 7th today of 2023, an article about groups like Blackstone and Apollo and Ares. These are, multi-$100 billion private equity groups that are trying to raise money in the RIA space. And they're providing some kind of solution that gives underlying clients of RIAs access to private investments in much the same way. So I think the market has realized there needs to be a solution. Mm-hmm. The large behemoth private equity groups are really good at deciding, hey, we're going to provide that solution, and then let's raise as much money as possible. And so we think that the overall thesis is correct. We just have, there are a lot of differences in how we execute that thesis versus, let's say, a Blackstone or someone that's $1 trillion asset manager.
WAS is a solution. What are the different asset classes, types of investment that make up the overarching solution?
Right. So you can think of it in terms of buckets, and we're trying to match
up
what the liquidity would be in a given bucket with the underlying asset that we're going to own. So very big picture, private investments, which are call it 10-year type commitments. We have a bucket for that. We refer to it as Global Private Strategies, or GPS for short, which is a best ideas annual vehicle. So GPS 5 is the 2023 vehicle. And every year there are 10 or 12 line items that'll make their way into that vehicle representing different private asset classes. So think real estate, venture capital, mm-hmm. private equity, energy investments, private credit, et cetera. And any given year, theoretically, different things are going to be, more or less attractive. So it's not a 20% exposure to these 5 asset classes type of thing. It is meant to be opportunistic, and we think over a long period of time that'll accrue to the underlying investors. So that's the private bucket.
Okay.
Multi-series is what I think of as just the hedge fund bucket. So think quarterly liquidity, looking for fund managers that have some edge in what they're doing. And there are probably, I think, 13, 14 underlying line items there. And any given line item might have 30 to 50 positions at any mm-hmm. given time. So a lot of diversification. People always ask on the hedge fund side, why would you invest in hedge funds? The fee structures are high. And yeah, the reality is fees have come down quite a bit over the years, but they are still higher than investing in a mutual fund. The reason you would do so is because the best portfolio managers go start their own hedge fund, and so they can control their own destiny, and they make more money that mm-hmm. way. And so when I was growing up, in college, I remember Peter Lynch. Magellan was the most famous mutual fund guy, and young people aspired to go, do that. I'm going to go work for Fidelity and manage a big mutual fund. Well, no 22-year-old is really thinking that these days, but the hedge fund space still has a lot of very smart portfolio managers, and there are niches inside that can be taken advantage of. And the gist of it is we're trying to provide returns for our client base or any LP in the partnership that is going to have a low correlation and probably a lower volatility than equities.
That's 2 buckets.
Number 3, the income series is private credit focused. So it's an evergreen vehicle, a little less liquid, not straight quarterly liquidity, but there's a quarterly gate. It would take a couple years to get one's money all the way back out of it. But that allows us to invest in private credit. In 2023 here, what we've seen over the last 18 to 24 months is a real wealth transfer from equity owners to lenders in the form of interest rates rising and spreads starting to come out. where, 3, 4, 5 years ago, you could argue that you really just didn't want to be a lender in this world. Like the interest rates were so low, you wanted to be a capital taker, be the equity guy and take advantage of low rates. And that's shifted. And this is something that happens over cycles and has, for a long time and will continue to. But the world is shifting now to where it's advantageous to be a capital giver. You can demand a high rate of return, and we're not just talking about lending to companies, but asset-backed lending and all kinds of other areas in there. And so what at the beginning of 2022 might have been a 7 or 8% type loan probably looks like 12 to 14 today. And as an underlying investor, if I'm thinking about the possibility of being able to generate double-digit returns in a relatively safe way by lending money, that sounds pretty good.
Okay, that's bucket 3.
And then bucket 4 would be tail risk. And so we have an agreement with a specific fund, and think of it as buying way out of the money puts on the S&P in a much more sophisticated way than you or I could do it on our Schwab platform or Fidelity platform. This particular group manages tens of billions of dollars, and we think is the best one out there at doing it. And in a very short summary of why that's interesting is that this group we think will make money over cycles. So net, this is a positive returning asset class, and they will make a lot of money at the exact time when you would need it the most, which is when the market, is at its lowest. And so if you can point me to an investment where the market crashes 20, 30%, whatever the number is, and you're being delivered a bunch of capital that can then be put to work in assets at theoretically a much lower price, or in very simple terms, this is an asset class that has a very negative correlation to the market. That's pretty advantageous for the individual investor.
So, Chris, what are the different segments or asset classes that make up WAS?
So it's a multi-series limited partnership. So think of it as solutions or buckets where each asset class is in that solution appropriate for whatever the underlying liquidity is in that vehicle. So for example, private equity, which could include real estate or venture capital or you name it, those are generally going to be 10-year lockup type vehicles. So that is in the solution that we call Global Private Strategies, or GPS for short. Solution number 2 is the multi-strategy limited partnership. Think hedge funds, quarterly liquidity type investments. Solution number 3 is the income series. So think private credit.
Okay.
And the liquidity of that is a little longer than a hedge fund liquidity, but think a couple years to get all of the money back out. And it is an evergreen vehicle.
Okay.
So solution number 4, which we call tail risk, is exactly that. It's effectively a hedge against a market crash in the form of buying way out of the money puts against the S&P 500. We scoured the landscape for who we thought was going to be the best fund to invest with in the tail risk space. There are dozens of them out there. And the great thing about this type of an asset is that the correlation is very negative to the stock market. So at a time when the market faces a difficult period and might be down 20, 30, 40% like what we saw in 2008, this strategy is making a significant amount of money. And so first of all, that helps clients sleep at night in a time like that. Second, you're returning capital to clients and can put that back to work in a portfolio at the exact time when you would most need to. But if you want to just run the numbers of what a portfolio looks like with tail risk insurance in place, just from a volatility perspective over a long period of time, it is very advantageous. And that goes into the psychology of the underlying investor, and those of us who were around in 2008 remember how stressful that was. And a portfolio that had this exact fund manager in it in 2008 looked dramatically different than the down 37% that the S&P witnessed.
Chris, why WAS over all the other private investments?
I think at the core of it, what we're looking for is an illiquidity premium over public markets. If we were going to invest in private equity and we didn't think we could outperform the equity market, there would be no point. So where is the largest illiquidity premium, or where are the parts of the market that are less efficient? And I think you can argue in public equities that as you go down into the small cap world, markets get less efficient. The same thing happens on the private side. So a $100 million or $300 million office building in New York, if it goes to market, is probably going to price exactly what it's worth. There's a lot of eyeballs on it, in the same way that there are a lot of eyeballs on Apple stock or Coca-Cola stock. In real estate, an $8 or a $10 million asset in a secondary market is not going to trade with anywhere near the level of efficiency that a mega asset in a market like New York or Los Angeles or Dallas or wherever might trade at. So what we're looking for is the inefficiency in the market, and then finding operators who are able to take advantage of that inefficiency. And I really think the same concept goes for roughly all the asset classes in the private world. So if private equity is the same way. A private equity backed business that is doing $10 million of annual cash flow will trade for a lower multiple than a private equity backed business that's doing $50 million of annual cash flow. So when we see these large solutions from the mega private equity groups out there that are managing $1 trillion or so, their solution is by definition large cap, a large cap solution. And we just believe that that's not the right way to invest in private and alternative markets. We're looking for the markets that are less efficient and where we are therefore able to capture more of that illiquidity premium. And that's hard to do, because you can't just call up Blackstone and say, give me your total alternative investment solution and do that. We think you could do that, but that is not going to provide the returns that clients really want over a long period of time. So what the secret sauce is that we have a relatively well-seasoned 6-7 person investment team that is able to utilize their networks and the networks of other institutional investors, endowments, foundations, those types of groups, to find the right deal flow. And if you just hang out a shingle in today's environment and say, hey, we're ready to allocate money, whoever wants to come sell us something, come on in, then you have an adverse selection problem. You will not find great deal flow. So that's ultimately what we're trying to do. And that lower middle market or small cap theme goes for real estate, it goes for private equity, it goes for venture capital, goes for direct lending and private credit, you name it.
Chris, what are your years of experience, and what's a good ballpark of the 6 or 7 people? What's the years of experience we have on this investment team?
Sure. So I spent my prior life at a hedge fund for 11 years doing hedge fund and private equity work on the buy side for the actual fund manager. And I've been allocating capital in the same way I am today for 13 years. Of the investment team, we have 5 members that are over the age of 40. We got a little gray hair, and every single person in those 5 has been an allocator outside of the wealth management space. So grew up in the investments world, allocating capital, taking risk. I think that's important as an investment team, that people have differing experiences. And so you take 5 different people that are somewhere between the age of, call it 40 and 55, 60 years old, and put it together, and we've got a pretty seasoned investment team.
If I own an RIA, or I'm a ultra high net worth individual, why would I choose to invest in WAS or partner with WAS and the WAS solution versus just me going to Blackstone or one of the mega, or even making my own direct investments with other people come and ask me for money?
Right. No, I think that's the $1 million question. So the very short answer is that either of those two solutions probably ends in a suboptimal outcome. And what we have found is we were setting up and building the WAS platform for an internal client base, and then realized that we were getting sold this exact same product, but what we felt like was an inferior version of it by the major private equity groups that are out there. And so why weren't there other RIAs or outside family offices or those types of groups that were, could put their money in our vehicle and ride alongside with a very reasonable fee structure, ultimate transparency on what we were doing, and then basically the ability to be able to piggyback on a 6-7 person investment team that was spending all their time doing that. And the reality is, a smaller RIA that might manage $250 million or $500 million or even $1 billion of assets doesn't have the resources to have that investment team. So we have a number of RIAs, a number of outside family offices, or just ultra high net worth individuals that manage their own portfolio that are invested in Western alternative strategies, and it forms a sleeve of their overall portfolio and has worked out really well. The Blackstones, the iCapitals, the Cases of the world, the other real problem that they have is a lot of capital has to go into any given investment portfolio company or fund, you name it. A good example would be a fund investment from a group like JP Morgan. They have to put $1 billion of capital to work through the JP Morgan private bank to make the economics make sense for them to put a fund on their platform. Almost by definition, that eliminates all of the funds that we would be interested in looking at. We really will never invest in a $1 billion private equity fund. To get into that lower middle market underlying company, which usually is a $10 to $30 million equity check, the fund size probably shouldn't be larger than about $500 million. So that's where the secret sauce comes in, is then how do you find the best $300 million, $500 million lower middle market private equity fund around the country? And the answer is that you got to do a lot of looking and turn over a lot of rocks. But the bigger platforms are at a structural disadvantage versus where we are because they have to put so much capital to work.
How at WAS do we make this a very partner-friendly relationship with other RIA owners?
Sure. So whether it's an RIA or the chief investment officer of a family office, the goal is to simplify for them. So there's a menu of options. It's very easy. There's a stack of K1s at the end of the year that someone gets before April 15th, which is very rare in our industry. Someone can go through the custodial platforms like the Fidelities or Schwabs of the world, or just invest directly as an LP. Very easy there. And we're not competing with those groups. And I think that's the key here, is we're investing our own money and the money of our clients and doing this for a number of years, to the point where we now have an established entity with 12 years of audits and a third-party administrator and very institutional quality controls in place, and very reasonable fee and expense structure that is designed to make life easy for all of the investors.